Everyone is talking about silver, and that alone should make you uncomfortable. Because markets don't break where everyone is looking. They don't collapse in the spotlight. They fracture in the background, quietly, while attention is pulled somewhere else. Over the last 48 hours, the market sent a signal that most investors missed, not because it was hidden, but because it wasn't dramatic enough to trend. This is not a prediction. This is pattern recognition. When real damage begins, it doesn't announce itself with panic. It shows up through subtle behavior changes, small shifts that feel easy to ignore if you only watching price charts or headlines. And right now, the market is behaving in a way that doesn't belong to a healthy system. Most people are focused on silver. The charts, the sudden drop, the explanations. Retail attention has locked onto a single asset, trying to understand whether the move was manipulation, profit-taking, or just another volatile swing. Emotions are doing what they always do. Some are panic selling, afraid this is the start of something worse, while others are confidently buying the dip, convinced this is an obvious overreaction. That emotional split alone tells you something important. When everyone is staring at the same asset, risk is usually somewhere else. Retail money reacts to price. It needs a visible trigger. It waits for movement, then demands an explanation. Smart money operates in reverse. It moves first, quietly, before the story exists. And over the last 2 days, that quiet movement has been impossible to miss if you know where to look. Instead of chaos, we saw subtle tightening. Liquidity began to thin in places where it normally flows smoothly. Volatility started behaving out of character, not exploding upward, but shifting patterns in ways that signal stress under the surface. Defensive positioning appeared without headlines, without urgency, without the emotional fingerprints of fear. These are not behaviors that appear in strong markets. Healthy markets absorb bad news. They digest shocks. They show resilience through participation and depth. What we're seeing now is different. It's not loud. It's not violent. It's restrained. And that's exactly why it's more concerning. Markets reveal stress through behavior, not headlines. Silver didn't cause fear. Silver exposed it. By the time silver moved the way it did, the cracks were already there. Commodities often act as early messengers, not because they're the core problem, but because they respond quickly to changes in confidence and liquidity. Historically, confidence breaks before structures break. Belief erodes before systems fail. The surface reacts after the foundation has already shifted. Silver moved because something deeper was already wrong. This is where most people get the sequence backwards. They see the move and assume it created the risk. In reality, the move is usually the echo of something that happened earlier, somewhere else, out of view. The market doesn't warn you directly. It hints. It whispers. And then, eventually, it speaks loudly, when it's already too late to adjust calmly. To understand what's happening now, you have to separate public money from smart money. Public money waits for confirmation. It reacts to headlines. It needs consensus to feel safe. Smart money doesn't need explanations. It doesn't need comfort. It responds to changes in flow, risk, and policy conditions long before those changes are visible to everyone else. Smart money leaves signals, not announcements. Those signals showed up over the last 48 hours in the form of quiet repositioning. Not mass selling. Not dramatic exits. Just controlled adjustments. Reduced exposure here. Increased protection there. Subtle moves designed to prepare, not to react. And that distinction matters more than most people realize. By the time the story makes sense, the opportunity is gone. This move also felt different, and that difference is critical. There was speed, but not panic. Selling, but not chaos. The tone of the market remained calm, almost indifferent, while positioning told a very different story. That combination rarely appears during emotional sell-offs. Emotional fear is loud. It's messy. Controlled fear is more dangerous than panic. Panic burns itself out. It creates extremes that eventually reverse. Controlled fear is strategic. It's deliberate. It spreads quietly and reshapes the market without drawing attention to itself. It's the kind of fear that belongs to institutions, not individuals. This is why focusing only on silver misses the point entirely. Silver is the symptom, not the disease. The real signal lies in how different parts of the market are interacting or failing to interact the way they normally do. Liquidity doesn't disappear overnight. It recedes. Participation doesn't collapse instantly. It thins. That's exactly the phase we're in now. Over the last 2 days, the market showed signs of stress without showing fear. That's the dangerous zone. That's when risk builds unnoticed. The crowd is still asking whether silver will bounce, whether this was an overreaction. But systemic stress never stays contained. It migrates. The earliest warning signs never feel urgent. They feel confusing. And confusion is exactly what allows smart money to move without resistance. This isn't about calling a crash. It's about recognizing a transition in market behavior, a shift from stability to fragility. The market doesn't flip a switch. It changes posture. And right now, that posture is defensive. If you're waiting for confirmation from headlines, you'll get it, eventually. But it will arrive after the easy decisions are gone. Silver crashing isn't the headline yet, but the behavior behind it matters far more. Because by the time everyone agrees something is wrong, it's already priced in. This isn't just about metals. And it's definitely not just about stocks. Under the surface, the real tension is forming where most people aren't watching closely enough: currencies. Currency markets don't move on emotion. They move on confidence, positioning, and trust. And over the last couple of sessions, subtle stress signals have begun to appear. Nothing dramatic, but enough to suggest that global positioning is quietly shifting. When currencies wobble, everything else reprices. That's not an opinion. That's structure. Currencies sit at the foundation of the financial system. When confidence in currencies weakens, even slightly, assets don't fall immediately. They adjust. And that's exactly what we're seeing now. The dollar hasn't collapsed. It doesn't need to. Stress doesn't always show up as weakness. Sometimes it shows up as instability. When currency moves stop making intuitive sense, that's when pressure is building. Global investors don't announce their discomfort. They hedge. They rebalance. These moves don't make noise, but they leave footprints. And those footprints are becoming harder to ignore. Metals moving. Stocks wobbling. Bonds behaving strangely. These aren't separate stories. They're reflections of the same underlying adjustment. Confidence being repriced across the system. Which brings us to an uncomfortable question. If these signals are present, why does it still feel like everything is fine? Because the media is underplaying it. Not out of malice. Out of structure. Mainstream financial coverage is designed to isolate events. One move, one explanation. System-wide transitions are messy. They don't fit clean headlines. So instead, coverage focuses on fragments. A dip here becomes a healthy correction. Volatility is framed as temporary. Liquidity tightening is softened into normalization. The language is carefully chosen. Reassuring. Familiar. And it works. Because reassurance doesn't calm markets. It calms people. When people feel reassured, they stop questioning. They stop preparing. But historically, reassurance is most aggressive right before reality becomes unavoidable. Every major shift follows the same pattern. Early signals appear. They're dismissed as noise. And only later does consensus catch up to what behavior had already been revealing. Patterns repeat. Timing never does. This is where experience matters more than intelligence. If you've studied enough cycles, you don't need dates. You recognize the phase by how things feel. Right now, we're not in a collapse phase. We're not in a recovery phase either. We're in transition. And transitions are the most dangerous part of any cycle. Because during transitions, old rules stop working before new ones are understood. This is the phase where small shocks produce outsized reactions. Where calm days hide fragile conditions. That doesn't mean a crash is imminent. It means the environment has changed. And most people are still operating as if it hasn't. The mistake many make at this point is asking, what should I do? That's the wrong question. This isn't about giving instructions. It's about learning how to think during unstable phases. Because survival in markets isn't about perfect timing, it's about awareness. Watch actions, not statements. Institutions reveal far more through what they do than what they say. Watch liquidity, not prices. Prices can be held up temporarily. Liquidity cannot. When participation thins, when moves feel exaggerated relative to news, instability is increasing, even if prices haven't fully reflected it yet. Awareness doesn't mean fear. It means preparedness. The market is not asking you to panic. It's asking you to pay attention. Silver crashing isn't the headline yet. But when the real headline arrives, it won't feel sudden. It will feel inevitable in hindsight. People will say the signs were always there, that it was obvious, that it made sense. It always does, after the fact. Thank you. Please like the video and subscribe to the channel if you like the content.